Let me ask you something that will make you uncomfortable. When was the last time you questioned why everyone suddenly cares about your carbon footprint, but nobody talks about the carbon footprint of printing money? When did we collectively agree that digital numbers on a screen are more real than the metal that has held value for 5,000 years? And here's the real question that should keep you up at night. Why are central banks buying gold at a rate not seen since 1971, while every financial advisor on television is telling you to put your retirement into index funds? Something is happening. Something massive. Something that the financial media is working overtime to keep out of your peripheral vision. And if you understand what I'm about to show you, if you can connect the dots that they've deliberately scattered across different news cycles and different continents, you'll see a pattern so clear, so undeniable, that you'll wonder how you ever missed it. This is not about price predictions. This is not about telling you to buy anything. This is about facts. Verifiable, documented, impossible to ignore facts that are hiding in plain sight. By the end of this investigation, you're going to understand why the largest institutions in the world are quietly repositioning themselves for a monetary system that looks nothing like the one we have today. Let's start with something that happened in February 2025 that barely made a ripple in the news. The Shanghai Gold Exchange, the largest physical gold exchange in the world, announced that for the first time in its history, daily withdrawal requests exceeded available inventory for 7 consecutive trading days. 7 days. Think about that. The place where more physical gold changes hands than anywhere else on Earth ran out of deliverable metal for an entire week. The official explanation was routine. Lunar New Year demand, seasonal patterns, nothing to see here. But here's what they didn't tell you. Those withdrawal requests weren't coming from jewelry manufacturers or retail buyers. According to shipping manifests that were later leaked to industry insiders, the majority of those withdrawals were going directly to sovereign wealth funds and central bank custody accounts. The governments of the world were pulling physical gold out of the exchange system, and they were doing it quietly. Now, you might say, okay, that's interesting, but it's just one exchange, 1 week, one anomaly. Fair enough. Let's look at what happened 6 weeks later. In March 2025, the World Gold Council published their Q1 Central Bank Gold Demand Report. The numbers were staggering. Central banks added 463 tons of gold to their reserves in just the first quarter. That's the highest quarterly purchase rate since they started tracking this data in 2000. 463 tons in 3 months. But here's where it gets strange. When you break down which countries were buying, the pattern becomes impossible to ignore. China added 98 tons. Poland added 29 tons. India added 19 tons. Singapore added 17 tons. The Czech Republic, not exactly a major gold player historically, added 7 tons. Even Uzbekistan added 6 tons. These aren't random purchases. These are coordinated moves by nations that have decided something fundamental about the future of money. And then there's what happened in May. The London Bullion Market Association, the organization that sets the standards for the global gold market, quietly changed their rules for the first time in 34 years. They expanded the acceptable list of approved refineries. Why? Because they were running into a problem. Demand for newly minted bars with current year stamps was outstripping their ability to deliver. Buyers, specifically institutional buyers, were refusing to accept older inventory. They wanted freshly refined metal. The LBMA's solution? Add more refineries to the approved list to increase production capacity. This tells you something critical. It's not that there's no gold. It's that the gold that exists in vaults, the gold that's been sitting there for decades, is not moving. It's locked up. The owners, whoever they are not selling. So the only way to meet new demand is to pull more out of the ground and refine it immediately. This is not normal market behavior. This is hoarding behavior. Let's talk about something that happened in July that absolutely nobody connected to gold, but should have. The Bank for International Settlements, the central bank of central banks, released their annual economic report. Buried on page 147 was a single paragraph about cross-border payment systems. The BIS noted that 23 central banks are now participating in Project mBridge, a wholesale central bank digital currency platform designed to settle international trade without using the dollar. 23 central banks. And here's the kicker. The announcement specified that the system includes a gold linkage mechanism. That's the exact phrase they used. Gold linkage mechanism. What does that mean? It means that in this new payment system, transactions can be partially or fully backed by gold held in custody. The digital currency isn't just fiat with a blockchain. It's explicitly designed to connect to physical metal. Now, connect that to what happened in August. The BRICS nations, Brazil, Russia, India, China, and South Africa, held their annual summit in Kazan, Russia. The media coverage focused on political tensions and trade agreements. But the real story was in the working papers that were published 2 weeks after the summit ended. BRICS announced they were creating a new payment system called the BRICS Bridge, and that system would allow member nations to settle trade in their local currencies backed by a basket of commodities. Gold was listed first in that basket. This is not theoretical. This is not some distant future proposal. In October 2025, Russia and India completed their first trade settlement using the BRICS Bridge system. India paid for Russian oil using rupees backed by gold held in a Reserve Bank of India vault. The transaction bypassed SWIFT entirely. It bypassed the dollar entirely. And it worked. So let's pause and add this up. Central banks are buying gold at record rates. They're pulling physical metal out of exchange systems. They're changing market rules to increase production of new bars. They're building payment systems explicitly designed to link digital currencies to gold. And they're using those systems to settle real trade right now. Does this sound like the behavior of institutions that believe gold is a barbarous relic? Or does this sound like preparation? Here's where it gets even stranger. In September 2025, something happened in the silver market that defies everything we understand about supply and demand. The Silver Institute, the industry's primary research organization, released their World Silver Survey. The report showed that industrial demand for silver hit an all-time high of 678 million ounces. That number alone is remarkable, but it's what's driving that demand that should make you pay attention. Solar panel production consumed 234 million ounces of silver in 2025. Electric vehicle production consumed 89 million ounces. 5G infrastructure consumed 43 million ounces. These aren't luxury goods. These are the infrastructure components of the green energy transition that every government in the world has committed to. And they all require silver. Not a little silver, massive amounts of silver. A single solar farm uses tons of it. And we're not building one solar farm, we're building thousands. But here's the problem. Total global silver mine production in 2025 was only 822 million ounces. Industrial demand alone consumed 678 million ounces. That leaves 144 million ounces for everything else. Investment demand, jewelry, coins, silverware, photography, medical applications. 144 million ounces to cover all of that. The math doesn't work. And it gets worse. In October, the U.S. Geological Survey released an updated report on global silver reserves. They downgraded their estimate of economically recoverable silver by 18%. 18% in 1 year. Why? Because at current prices, many deposits that were previously considered viable are now too expensive to mine. The energy costs, the labor costs, the regulatory costs have all increased faster than the silver price. So, the amount of silver we can actually extract from the ground just shrunk by nearly a fifth. Now, combine that with what happened in November. The Chinese government announced new export restrictions on antimony, a critical element used in solar panel production and battery technology. Within 48 hours, antimony prices doubled. The solar industry panicked. Manufacturing costs spiked. And what did the manufacturers do? They started stockpiling silver. Because if antimony is going to be restricted, if costs are going to be unpredictable, the one thing they cannot afford is to also run short on silver. So, they began building strategic reserves. This is the same behavior we saw with semiconductor manufacturers and chip shortages in 2021. When one critical input becomes unreliable, you hoard all the other critical inputs to protect your supply chain. And silver just became something that solar, EV, and tech companies are treating as a national security issue. Here's something that happened in early December that almost nobody talked about. The Perth Mint in Australia, one of the largest silver refineries in the world, announced they were suspending retail silver sales for 2 weeks to fulfill industrial contracts. Read that again. They stopped selling to regular people so they could deliver to corporations. When have you ever heard of a mint turning away customers during a bull market? This doesn't happen unless the demand from industry is so overwhelming that retail doesn't even matter anymore. And then there's the story that's still unfolding right now. In late November, the Mexican government, which produces 22% of the world's silver, proposed a new mining royalty law. The law would increase royalties on silver extraction from 7.5% to 15%. The Mexican Senate is expected to vote on this in January 2026. If it passes, the cost of producing Mexican silver increases dramatically. And since Mexico is the world's largest producer, that means the global cost of silver production just went up. Permanently. So let's connect these dots. Silver demand is at an all-time high, driven by irreversible industrial trends. Supply is constrained and getting more expensive. Refineries are prioritizing industrial buyers over retail. And the largest producing nation in the world is about to make it even more expensive to mine. This is a supply shock in slow motion. And the price? The price is barely moving. Silver is hovering around $30 an ounce as of December 2025. Does that make sense to you? It doesn't make sense because the price discovery mechanism is broken. The silver market is one of the last commodity markets where the paper market, the futures contracts, the ETFs, dwarfs the physical market. For every ounce of real silver that exists, there are hundreds of ounces of paper silver being traded, and that paper market is controlled by a small number of large banks that have every incentive to keep the price suppressed. Because if silver starts behaving like the scarce industrial commodity it actually is, the entire derivatives structure collapses. But here's what they can't control. They can't print solar panels. They can't print electric vehicles. They can't print 5G towers. And every single one of those things needs real, physical silver. Not paper contracts, not ETF shares, actual metal. And the gap between what the paper market says silver is worth and what industrial users are willing to pay for guaranteed delivery is growing every single day. Let's talk about gold one more time, because something happened in the last 2 weeks that ties all of this together. On December 5th, 2025, the Federal Reserve published their latest foreign exchange reserves report. For the first time since 1974, the percentage of global reserves held in U.S. dollars dropped below 58%. It's now at 57.8%. That might sound like a small move, but it represents the acceleration of a trend that's been building for 5 years. Where is that money going? Into gold? into euros, into yuan, into yen, but mostly into gold. Because gold is the only reserve asset that isn't somebody else's liability. When you hold dollars, you're holding a promise from the US government. When you hold euros, you're holding a promise from the European Central Bank. When you hold gold, you're holding an element. It doesn't require trust. It doesn't require a functioning government or a stable political system. It just exists. And that's why central banks are buying it. Not because they think it's going to go up in price, although they probably do think that. They're buying it because they're preparing for a world where trust in government promises is no longer sufficient. They're building insurance policies. They're constructing lifeboats. And they're doing it quietly because if everyone realized what was happening all at once, the rush for the exits would collapse the system before they're ready. Here's the pattern. The institutions that control the global financial system are moving away from pure fiat and toward hard asset backing. Not completely, not overnight, but methodically and deliberately. Gold and silver aren't relics. They're being remonetized in real time through central bank buying, through payment system integration, through industrial demand that cannot be substituted. The trend is clear, the direction is obvious, and the fact that this isn't headline news tells you everything you need to know about who controls the narrative. The people who print money don't want you thinking about things that can't be printed. The people who benefit from inflation don't want you holding things that hold value through inflation. And the institutions that profit from your participation in paper markets don't want you asking why they're quietly accumulating the physical assets they tell you are obsolete. But you can see it now. You can see the central bank buying. You can see the payment systems being built. You can see the industrial demand consuming supply. You can see the refineries prioritizing corporations over individuals. You can see the math. And once you see it, you can't unsee it. The silver and gold trend they hope you never notice is the most important financial story of our generation. And it's happening whether they talk about it or not. If this analysis opened your eyes to something you hadn't considered before, if you see the pattern now, do two things. Subscribe so you don't miss the next investigation. And leave a comment below telling me what you think. What did I miss? What else are you seeing? Let's figure this out together. Because the more people who understand what's happening, the harder it becomes for them to pretend it isn't.